Banking is an incredibly important industry which is based off a very simple concept. People with more money than they know what to do with can keep it in a safe and secure institution, which can then lend that money out to people who have big ideas but not enough money to make them happen. They give a small incentive to the depositors and charge a higher premium to the borrowers, making a profit for the service that they provide as a financial intermediary. This system has become more complex over time with things like fractional reserve banking and alternative capital sources. But if we strip all of that away, we will find that the heart of banking is this simple mechanism. For all of the hate that banks get, they can do a lot of good in an economy. To people who want a safe place to keep their money, they offer an almost 100% guarantee that the money left with them will still be there a day, a month, a century from when it was deposited. They also make that money readily accessible, online, over a phone, from a collection of ATMs, or simply through a plastic debit card. To people that want to borrow money, they are also the go-to institution for a fair loan based on lending parameters developed over time. We may hate things like credit scores and employment checks, but it's part of the reason why so many people are paying below 3% on their mortgages right now. Banks have become masters at mitigating risk by making everything as uniform as possible. So uniform, in fact, that even home loans, one of the most personalized financial products imaginable, can be bought and sold like commodities in financial markets. But even securitization, which was the catalyst for the global financial crisis, is still not the reason modern banking is broken. Banking is running into a problem today where it has become so consolidated that it can no longer effectively perform its role as a financial go-between. So, it's time to learn how money works to find out how the last financial crisis set us down a path that fundamentally broke banking to a point where we may no longer be able to fix it. This video was made possible by this channel's members and patrons on Patreon. For a bunch of cool perks, please consider supporting the channel on either of these two platforms. The current issue with banking really started in the mid-1990s. Back then, computers were just starting to take over the decision-making process of most junior-level bankers. Before this time, if you wanted to get a loan to buy a house or start a business, it was all about having a relationship with the local bank manager. A manager would sit down with a potential applicant in their office and look over the basic stuff. Do you have a job? Do you have savings? Do you have other assets? All of the stuff that banks still look at today. But there was also a more personal aspect to this whole process. A bank manager might actually ask someone's parents to vouch for them. This vouch would carry no legal ramifications, but it might mean if those same parents wanted a loan themselves to buy a beach house or an RV, they could get declined if their children were in arrears. This was all very colloquial, and it did work well all things considered, but it caused problems for the banks. The first problem was that bank managers were expensive. Given the responsibilities that they would personally take with their decisions to lend or not lend money, they were very well-respected professionals. Today, a bank manager is a glorified credit card salesman. Before the 1990s, a bank manager was as respected as a judge or doctor, and paid as well as one too. The other problem that this caused the banks was scalability. If a bank wanted to move into a new city, they would be without basic information needed to run the business. Someone with terrible financial conduct could walk into a new branch and possibly walk out with a loan. And when they inevitably default on their new loan, the new bank loses money that the existing local bank would not have made, because the established bank knew better than to not loan money to dodgy Doug down the street. Fortunately for banks, these problems were resolved as computers and crucially credit scores became widely adopted. Credit scores as we know them today did not exist before 1989. Today, your credit score has basically entirely replaced the role of building a relationship with a bank. Today, a bank manager doesn't even need to know your name. They can learn everything they need to know about you by reading a number off your nationally available credit file. Credit files have their own problems, but for now I am going to ignore them, because like it or not, they are here to stay. It is simply too easy and too profitable for the banks to be able to utilize this pool of data to make finance decisions. This has been made even easier still by computers and worldwide communications. Today, when you apply for a home loan, you will normally do so in one of three ways: online, at a branch, or through a mortgage broker. If you apply online, you will be asked to fill out a whole lot of details, and then those details will be turned into data points, and then that data will be sent off to an assessor. If you go through a bank branch or a mortgage broker, the same thing happens, only this time it's a bank employee or a broker that fills your details out for you. Inevitably, it all ends up in the same place: an assessment office, normally an assessment office in a low-wage country like India or the Philippines. Modern banks have been able to move their offices here because approving financial applications has become a very simple process. The workers in these offices simply need to verify that the data provided to them is correct by cross-checking it with official documents, and then they plug that data into an algorithm that gives the application an approval or decline. It's an elegant solution which allows for far more applications to be processed at a far lower cost. As I said at the beginning of this video, some of that cost saving has been passed along to consumers, which is a good thing, but it's about where the good news ends. In the early 90s, there were around 20 large banks vying for market dominance here in the States. Today, there are 4. Through a series of mergers, acquisitions, and bankruptcies over the years, major full-service banks have become increasingly concentrated. Big banks want to make sure that their operations are relatively uniform, so leaving the decision-making process up to one piece of software rather than thousands of bank managers just makes good business sense, even before considering the operating cost benefits. But as with a lot of things, something that makes good business sense doesn't always make good sense for the society at large. Again, I am going to ignore the issues that come along with credit scores. There are so many videos talking about just how terrible they are, so I don't want to repeat too much of what you probably already know. But I do want to focus on something else. There are people out there today that have perfect credit, good savings, a stable income, and yet still can't get a loan. Why? Well, because they have a financial situation outside the rigid parameters of the bank's automated framework. Someone working a normal full-time job is absolutely perfect for a bank application because an applicant can just put one simple point of data in their income field, their salary. But what about people that rely on tips for their income, or royalties, investment returns, rents, business profits, or even government allowances, as in the case with a lot of retired police and military personnel? What about them? Well, in banking speak, this is what is called supplementary income. And unfortunately, it is not particularly popular amongst big banks. Why? Because it requires some critical thinking beyond the scope of what this automated process will allow. The irony is that a lot of these income types can be more secure and more consistent than a salary. But because a computer doesn't understand that these types of incomes don't produce one neat little number every year, it has to do one of 2 things. Optimistically, the people entering the data into the computer will be told to be ultra-conservative. If you made $50K in 2019 and then $500K in 2020 off your business, then the bank is going to use the $50K figure. Often, the major banks just won't accept these income types at all, forcing people to go with lenders with less restrictive standards, but much higher interest rates. Interestingly enough, this will often be the exact same bank, or perhaps just a subsidiary of the bank, the only difference being that they charge a premium because reasons. These loan products used to be called subprime products, but for some reason, that naming convention fell out of style, so now bankers call those loans non-prime or non-conforming. Non-conforming is really the right word for these types of loans, because as I said earlier, you will often find that the people that are forced to take out these loans in order to buy a house are in far better financial positions than your regular salary man. The issue this creates is that it can force people into just getting a regular job over building out their business or pursuing some other profitable endeavor. Starting a business is risky at the best of times, and the best way to mitigate that risk is to make sure that your own personal finances outside of the business are rock solid. It really is hard to put yourself in a rock solid financial position without owning a home. And yes, it is possible to be financially secure while renting, of course. It's just a lot harder. The median net worth of an American household who owns the home that they live in is $255,000. The median net worth of a household who rents is just $6,300, according to a 2020 survey. Many promising individuals find themselves pushed back into the regular workforce simply because they don't want to miss out on the opportunity to own their own home. Unfortunately, for those who do end up sticking it out and start their own business, the bad news keeps coming. Dr. Richard Werner is one of the foremost academics covering the role of banks in the modern world. He has raised concerns about most of the issues I have covered in this video, but the biggest warning he has given out over the past 20 years has been that large consolidated banks are increasingly unwilling to lend to business. Business lending is inherently more difficult than consumer or residential lending. If a mortgage goes into default, then the bank will still have a house to sell to recoup some or all of their losses. If a business does not do well, it's likely that a bank will never see that money again. Businesses are also much more complicated. A bank trying to mitigate their risk would need to assess the health of a business, which is extremely difficult. Certainly, it is well beyond the scope of the standardized process used for mortgage applications. A non-standardized process equals expensive in the eyes of a big bank. Someone looking for a $100,000 loan to open a second store in a new city might cost the bank more in assessment costs than they could ever hope to get back in interest. This means that some banks just won't even consider giving loans to smaller businesses, and the ones that do end up charging much higher rates to make up for the costs involved in assessing these loans. Small businesses are incredibly important to the overall health of the economy. Back when banks were small and approval processes were much more personalized, businesses could get the funding they needed so long as the business idea made sense to the bank manager. Today, big banks only have the appetite to lend to big businesses. This graph shows the breakdown of mortgage versus non-mortgage lending compared to the American GDP. Note that the spike in mortgage lending in the 90s coincides with the plateau in non-mortgage lending around the same time. This stall is even more severe than it might initially look, because in that time, things like credit cards, car loans, and personal loans have become a lot more popular, meaning that good old-fashioned business lending is making up a smaller slice of this stagnating pie. Big businesses naturally favor products that are generic, uniform, and easy to replicate. This is normally fine, because it lets smaller businesses carve out a niche for themselves to be offering more unique products. Unfortunately, retail banking is next to impossible to get into, and even if a small bank is successful, it will probably end up getting acquired anyway. Breaking up banks is also extremely difficult. For the majority of average consumers, big banks offer better products, better accessibility, and better services than smaller banks could. Average consumers also don't want to wake up one day and realize that their Citi checking account is now with some new institution because Citigroup got broken up. It would be a pain, and it would undermine the confidence people have in the financial system. So, unfortunately, it looks like the role of banks as financial intermediaries will continue to be focused on projects that are worth the attention of some of the biggest companies in the world. This video was actually an unofficial part 2 of another video I made last month, detailing why companies do not care about staff loyalty anymore. So, if you found this video interesting and you want to find out what career planning has to do with the banking industry, go and check out that video too. As always, a big thanks to my channel members and patrons on Patreon for continuing to make it possible for everybody to learn how money works.